Good afternoon. I am Lou Antoine with Job Service Kalispell. Thank you for joining us for the January Blueprint for Business Success webinar, the first one of 2022. Attendees are muted, but we encourage you to use the chat box for asking your questions, which will be answered at the end of the presentation as our time allows. As usual, we ask that your questions and comments are polite and respectful to our attendees and the presenters. There is a 2-minute anonymous survey at the end, and we would appreciate you completing it. Your feedback helps us improve the program and offer future topics and content that is useful to Montana businesses. Today, we have the privilege of hearing from David Gilmer, a certified public accountant, accredited in business valuations, a shareholder, and the director of tax operations at JCCS, and Marija Berney, a certified public accountant and tax manager with JCCS. Please welcome David Gilmer and Marija Berney.
Thank you for having us today. We have a presentation for you on a business tax update that hopefully you'll find beneficial. My name's Dave Gilmer. I work with JCCS out of the Missoula office, and I've been with the firm since about 1998. I primarily work in taxes, but I also spend time performing business valuations.
Hi, and I'm Marija Berney. I'm a tax manager in our Whitefish office in JCCS. I have been with the firm for almost 12 years now, and I focus primarily with business taxation, and I work with a variety of industries and type of businesses.
This presentation is meant to tell you about general tax laws. However, when it comes to the law in your specific situation, the answer is always going to be, it depends. So even if we make a statement about how an item generally works, it may affect your personal situation differently. Therefore, we're not able to give specific advice. We're simply letting you know what the tax rules are at a high level. For how any of these items specifically affect you, you'll need to contact your CPA and go over the items in detail to obtain those answers. There are several portions of our presentation today. During the presentation, we plan on taking a question after the end of each section and then moving on in the interest of time to be able to cover all the material. Then at the end, depending on how much time we have available, we'll take some more questions. We're going to jump in with the federal tax law update with Marija.
All right, let's go ahead and get started. Thanks, Dave. So we don't have too many significant changes to the tax law that apply to 2021 tax return. However, there are a few, and some of them I will just cover very briefly, and some will dive into a little bit more detail. So our mileage typically changes from year to year, and for 2021, it went down to 56 cents a mile. Going forward in 2022, it will go up again. So that's just something to keep in mind and adjust our calculations for. Also, in year 2020, we were able to defer some of our self-employment tax payments. We no longer have that option available in 2021. So again, just taking a note of that. All right, moving on to a change that I think is a little more exciting. Historically, our expenses for business meals were only deductible up to 50%. And this year we are seeing a significant change. As we all know, pandemic has impacted hospitality industry pretty significantly. And this change is meant to give sort of a boost to that industry by now allowing us 100% deduction for meals purchased at restaurants. And that applies meals delivery and takeout, as long as it was prepared and provided by a restaurant, we can claim 100% deduction on it. And that includes our fast food and just all kinds of places. So that's pretty exciting. Of course, that comes with a requirement to keep track of meals purchased at restaurants versus, let's say, a grocery store. But that seems like just a little bit of extra effort to get this really nice deduction. And we will have this deduction available for 21 and 22. So that's pretty nice. Okay, let's go and move on to our next slide, where we'll talk about we'll talk about limitations that we now have to be aware when we're deducting losses and certain expenses. So let's start with one we're all probably pretty well familiar with, NOLs, which stands for net operating loss. So historically, we've been able to deduct net operating loss and offset and use it to offset any other income we had on our tax return. So let's say if we had some losses from a corporation or a partnership or Schedule C business and some other income on the tax return, let's say from interest and dividends, we were able to use all of that loss to offset whatever income we had. We are no longer able to do that. Now we can only offset up to 80% of other income that we have on the return. So there will be, no matter how big of a loss we have elsewhere, other income that's on the return, some of it is going to stay there. Okay. In addition to that, there's also limitation on the total dollar amount of the business loss we can claim, and that is $250,000 for single filers and $500,000 for married filing jointly. So that again limits our ability to offset business income with non-business income with business losses. Okay, and another limitation we have is interest expense deduction. That is something we've already had for a few years. It's been in place. Last year or two, it was eased up a little bit where we could claim up to 50% of our net income was the limitation on interest deduction. Now it's 30%. Now it only applies to certain types of businesses, certain income amount over 25 million, but there's also what's called tax shelters, and that is a situation where we have what's called non-participating owners, so sort of not active ownership, and that's where we can kind of fall into that requirement. So again, just something to keep in mind. Let's see, we've covered some 2021. Do we have any questions so far? Lou, is there a question?
Yes, at the end of that federal tax law header, is there a limitation on the per diem meal deduction in 2021 and 2022? Got
it. Okay, yes. Good question. So per diem is presumed, meal deduction for per diem is assumed to be provided by a restaurant. So it is subject to the same limitation as any other meal purchased at a restaurant. So 100% deductible. Yes. All right. Let's now move on to the current developments in the business tax law. So I think we've all pretty much gotten used to the tax law changing drastically from year to year, and it looks like this trend will continue for the next few years. The law that is currently being worked on is Build Back Better Act. We've probably all heard about different provisions of it. It's been in Congress for months now. And of course, nobody really knows what it will look like once the law gets passed. But for now, we will just have to look at the provisions that might become effective and just keep it in mind so we can plan ahead as much as possible. And with that, let's say the Build Back Better doesn't have too many business tax provisions. Most of them are focused on individual tax, but there are a few specifically business related that we will cover here. And the first one is a potential additional tax of 15% that could be applied on C corporations with income exceeding 1 billion. Now, of course, a lot of us don't deal with that directly on a day-to-day basis or in our tax filings, but anytime large corporations are being subjected to higher tax, typically on the other side of it, there's a consumer that ends up paying higher prices. So that's why we just want to be aware of this possible change. Again, business interest limitation that we just talked about, in our 2021 update. Here, the calculation is fairly complex and it's different for partnerships versus S corporations. In this act attempts to reconcile the discrepancies. So if this change goes through, it will actually simplify our calculations a little bit. So that would be a positive. Let's see, small business stock, currently we have an option to exclude up to 100% of the gain on qualified stock. Doesn't come about too often, but when it does, it's nice to have this exclusion. And looks like we could potentially lose 50% of that exclusion and now be taxed for AMT. So again, just something to keep in mind. Okay, here's one that if it becomes law, I think a lot of us will be impacted directly. So a little bit of history. A few years back, I believe starting with tax law changed by Obama, this new tax called net investment income tax, which is 3.8%, was applied to, just like the name suggests, what was applied to investment income items. So this is our interest, our dividends, capital gains, and it was applied at certain income levels over 250,000. So this proposed change would make our business income, our regular income, non-investment income, subject to this tax as well at certain income levels. So that means our pass-through entities, our S corporations, our partnerships potentially could be taxed with this additional percentage if we're at income levels above 400,000. So, 400,000 is not that high when we really look at our businesses. So that could be a significant change. Okay, another potential limitation to business losses. Again, they're trying to limit our ability to reduce non-business income with business losses. And this provision would just eliminate any opportunity to offset non-business income, making business losses only carrying forward and offsetting business income in the future. All right, let's see what else we have. If your income is over 10 million, you could be subject to additional surtax. So if you make more than that, consider yourself warned, might pay more taxes. And there are various other credits that are discussed and could be expanded or contracted. We're not going to dive into those here. All right, and let's look at this slide just to see what was originally in the Build Back Better, and it did not go through House. So C corporation tax rate is not going up to 26.5%, so we get to keep the same C corp rate. Qualified business income deduction, really nice deduction that our small businesses have. We get to keep that as well. And estate and gift valuation rules on non-business assets, there's no change there. All right, and that looks like we have all on the current items in Congress. Do we have any questions?
Yes, there is one. Are there changes expected to the capital gains tax rates?
Right, that has been a hot topic for the last probably several months at least, and it looks like we get to keep the same capital gains rates that we've had for a while. Let's see. Another item that has been in discussions for a while, not currently in Congress, but has been a hot topic, is the ability to deduct state taxes on the federal business tax return. And we might potentially get some guidance from the IRS in the near future on ways to do that. Maybe not quite on Montana yet, but we're getting into the state items here. So with this, I'm going to turn this over to Dave, and he can go forward with the state specific items.
Yep, Maria, this is one of those items. It's called the SALT limitation. SALT stands for state and local taxes, and it's basically where the federal and state laws kind of come together. So what the IRS has proposed is that if a state implements an entity level tax and charges the tax directly to the entity, that they are going to allow that as a deduction on the federal return so that your K-1 is lower. When the Tax Cut and Job Act passed back in 2018, this limitation where individuals cannot deduct more than $10,000 of taxes on their itemized deductions, that's been a hot topic and been one of the main items in the news across the country. And so states like California and New York, they'd been working overtime trying to find ways around that the IRS kept shutting down. But they've indicated with a proposed regulation that they do foresee a way around this. Now, if they get a regulation into place and it goes through, Montana is not in a place yet where this would apply to us. We would actually have to change our tax laws on these flow-through entities to make it work. So you may be filing income tax returns in Montana and be familiar with either withholding of tax on partners or shareholders that are non-residents, or maybe filing a composite return. Neither of those would qualify as the type of tax that the IRS is saying could be deducted on the federal return. So something to keep aware of if you're a business owner, especially if you're a business owner doing work and filing returns in other states, because those other states may have that type of tax in place where that will apply to you. So, but I'm going to focus on state changes, specifically Montana. The tax simplification has gone through. Congress has wanted to do this for a number of years. They finally worked with the governor to make it happen. There's a number of things that are going to be here. Most of them are going to be directed towards individuals, not businesses, but since as a business owner, you have to file and pay taxes at the individual level, I think this is all going to apply to you. It's going to happen in two, I'll call it two tranches, two different times. The first items are going to go through for 2022. So this is your 22 return that you'll file next year. Right now you're doing your 2021. So for 2022, there are 15 Montana credits that have been repealed. I'm not going to go through all of them. I do have them up on the slides. The first four are the ones that I consider the largest ones that I see more frequently. The first one, the energy conservation credit, and the third one, the college contribution credit. I see those numerous times every single year. The second and fourth, the alternative energy and the geothermal systems, I'll see those once every 2, 3, maybe 4 years. The rest of them, I've maybe seen once in my career where it applied to somebody, or just it has not applied to any of the people that I work with. And that is one of the reasons why they wanted to do this simplification. There's a number of credits that just have very little application to the general public. And so they just want to clean it up and get rid of some of those. In return for having these credits go away, the top tax rate is going to drop from 6.9% to 6.75%. Most individuals are in the top tax rate because you hit that around, $17,000 or $18,000 of taxable income. One item, if you jump to that last bullet point, one item actually that is a credit that will be retained that will go up is the elderly homeowner credit. And that is for elderly individuals with lower income that are paying property taxes or paying rent, where they can get a credit on their tax return for that. The credit is limited currently to $1,000. That is going up to $1,150. And then the last item that I wanted to point out for changes in 2022 is that third bullet point, the tax credit for contributions to a student scholarship organization or an innovative educational program. So basically what that means is If you want to do a donation to a school, then you can, and we're talking, I believe we're talking elementary, middle, high schools. If they registered themselves with the Student Scholarship Organization, then you can do a donation to that organization. They will make sure your donation certified and you'll get proof of that. And you'll get a dollar for dollar credit on your Montana tax return so that the money that you paid to the school will reduce your Montana income taxes. The prior limit, so that's been around for a little while, and the prior limit was just $150 per person. That limit has gone up to $200,000. So there's a potential there that if you want to direct where some of your tax dollars are going, and you want it to go to a particular school, you might be able to do that. Then after 2 more years, there will be the rest of the changes that come in play for the simplification. The first is going to be that Montana has always let you file however you wanted. You could, if you were married filing joint on federal, you could be married filing separate on different forms or married filing separate on the same form for the state return. Well, they're going to require that whatever your status is starting in 2024 on the federal return, that's how you're filing for Montana. One of the reasons why married filing separate on the same form is so popular is because there was only one tax table and you worked your way through all the lower brackets before you got to the higher bracket, regardless of being single or married. So jumping down there further, there will now be 2 different sets of tax brackets, one for a single, one for a married filing joint. So that shouldn't be an issue anymore. Right above that bullet point, you will also notice that we currently have 6 tax brackets, and that will go down to only 2 brackets in the future. So there's only one tax bracket that you'll work your way through. That's the 4.7%. Once you've done that, everything will be taxed at the top bracket of 6.5%. Now, the biggest change that's going to happen is Montana's always had a lot of adjustments to the federal adjusted gross income. So when you did your return, you would take your federal AGI and you would add certain things back and be able to subtract certain things out before getting to your Montana adjusted gross income. And then after that point, you would either take the Montana standard deduction or the Montana itemized deductions and whatever exemptions that Montana has in place. What is going to occur is that instead of starting with the federal AGI, we'll now be starting our Montana return with the federal taxable income. So this means a few things. It means that we're going to get benefit of the federal itemized or standard deductions, but it also means that some of the adjustments that we've been getting in the past are going to be gone. An example that we see quite a bit is the Montana Medical Savings Account. You get to make a contribution into that account, deducted on your Montana return as an adjustment. That is something that won't be around for 2024 and forward. So, and then the final item is the capital gains tax credit. That has been repealed, and one adjustment that they will have on the return will be to subtract 30% of your long-term capital gains from your taxable income. So if you're in the 6.5% bracket, that essentially will get your capital gains down to around 4.5, like 4.55%. And that is the Montana simplification. Lou, did we have any questions come in related to this topic?
Yes. With all of the changes, do you expect the overall taxes to go up or down moving forward?
That's a good one. So with any tax law, whether it's a simplification or a complication, there's going to be winners and losers. And so some people are going to come out ahead, some will come out behind. Those credits I mentioned, most of them don't get used a lot. But again, the energy credit and the college contribution credit, those I see that do get used. So people who were taking that credit, they're going to lose ground because of not having that credit anymore. But them and everyone else should come out ahead in the fact that the top tax bracket is going to drop, and those that got the elderly property tax credit, homeowner credit, that's going to be slightly higher. And starting from the federal taxable income, the people who were taking standard deductions, they should have benefit of having a higher federal standard deduction than they were getting previously on the Montana returns. But by
David?
not, sorry.
No, you go ahead and finish that, and then another one just popped up for us.
Okay. But starting with the federal taxable income, we will lose out on some of the subtractions that we were able to take before, like recalculating the taxable portion of Social Security or exemptions to pension income. So if I had to, my gut feeling is that the majority of people are probably going to come out a little bit ahead, and then there will just be a smaller number of people that were taking advantage of some of the things that are going to be gone that are going to come out behind on this situation. But the state's goal was to be as neutral, as revenue neutral as they could when they put it in place, so that overall across all the taxpayers, that it didn't make the overall taxes go up or down that much. What's the other question, Lou?
Well, thank you, David. Is Montana still going to tax Social Security benefits? I don't know if that applies now or later. I'll leave that to you to address.
Right. As of now, they have been and will continue to. I haven't seen anything in the law changes that indicate that they are going to get rid of that. It's always a popular topic, though, at the federal and state level during political campaigns of making that non-taxable, but I haven't seen anything thus far that does that. So thank you for your questions. I'm going to jump into a new topic here, some other Montana issues. I'm going to hit this kind of light. Hopefully you guys are all aware of it, but when you own a business, you have to pay personal property taxes to the state and county. It's actually to the county. And so when you own real estate, you pay real estate taxes. When you have a vehicle, you license it, you pay taxes. Well, if you're a business and you have equipment, furniture, computers, supplies, you have to pay taxes on that. So hopefully you're aware of that. Those reports are due on March 1st every year. If you are a new business owner and haven't done this before, then you're not going to be able to file online where the state requires it in their transaction portal. So you'll have to reach out to the Department of Revenue and get a paper version of the form and then fill it out. But then after that, you'll be filing online. And then if you're filing late, there's a 20% penalty. But the real reason why I wanted to bring this up, I guess one other thing is that if you have property in more than one county, you have to file a separate report for each county that you have property in. The real reason why I bring this up, again, hopefully you're already familiar with this, but there is a change on this. So previously for 2021 and prior, you were exempt from filing if the fair market value of all your personal property was $100,000 or less statewide. That exemption amount starting for this year, for 2022, has tripled up to $300,000. And you may have noticed on the last slide, I did say that these get audited. So if you have a filing obligation or you're a new business and you haven't done this before, you might want to make sure that you are filing these, because they do get looked at. So that's all I had on the property tax side. Lou, anything come in that short amount of time?
Yes. When they audit these, what do they do?
So the word audit always catches people's attention pretty quickly. So for the most part, they're going to want to do an on-site visit. They're going to look around your facilities and see what you have. They're probably going to request a copy of your depreciation schedule from your income tax return. And they're going to compare what's on the depreciation schedule and what they physically see when they're on site with what you reported on the property tax form. And they're just going to look for anything that you have that you haven't reported. So, like I said, I wanted to hit that pretty light because we have some other issues that are maybe a little more pressing. And I think this next one falls into that category, and that's multiple state issues. And there's going to be 3 different sections to this topic. The first one is going to be on income taxes. When you have a business, if you're doing business in multiple states, you have income and have to pay income taxes to those other states, to all of the states. The way that the states determine how much of your net income should be allocated, or I should say apportioned to that state, is usually on a three-pronged system. They look at the revenue generated from that state, property that you own or rent in that state, and the wages that you paid in that state. Now, all states are a little different. Some don't look at all three. They might only look at two or might only look at one. Some of them weight all of these things evenly. Some will put extra emphasis on one of the three items. One of the reasons why I'm bringing this up is because starting with the tax returns we're about to file for 2021 is that Montana has changed from an equal weighting of those factors to double weighting the sales factor. So for most Montana residents and business owners of Montana businesses, this won't be that large of an issue to you because all your income's you're eventually, if you're a Montana resident, you're gonna pay Montana taxes on it. But for out-of-state companies that have some of this in Montana, or multiple state companies, multi-state companies, the amount of net income that Montana is gonna want allocated to them will be calculated differently now, and there will be a little bit more weighting on the revenue factor as opposed to property or wages. So moving on, so one of those items actually that I just mentioned was wages paid to employees in another state. And this whole pandemic and working remotely has exploded, and it's caused a lot of new issues that companies haven't dealt with in the past. And one of the items that we just wanted to make sure that you guys were aware of is the employment responsibilities and payroll tax responsibilities that you have if you have remote workers. So we see this in a couple of different areas. There are companies that are hiring workers that already live in other states because maybe there's more of a labor pool there. And the other place where we're seeing it is companies that have employees that request to work remotely, and then they move to another state, or they're just traveling long-term to other states. And so the way, the issue that you run into is if you have employees in another state, they're earning their wages in that state, even if they're not a resident of that state. And so you as an employer, you have an obligation to withhold taxes of that state and remit them, along with potentially having a requirement to have unemployment coverage for that state. So that's something that you have to be very cognizant of if you're going to start allowing some benefits and some remote working to your employees to do that. If they go to another state, you potentially are going to run into filing requirements related to employment taxes there. And then the third topic related to multi-state issues has to do with sales tax. And we live in Montana, we're not really used to a sales tax for the most part. There are some local resort taxes that we deal with, but I'll back up here. There's a court case that went to the US Supreme Court in 2018, and it has to do with a state's ability to collect or to require that businesses, even if located in a different state, collect and remit sales taxes to that state. So in this case, Wayfair is an online retailer, and they're selling all across the country, and they were selling into South Dakota. Well, South Dakota sued them, and it went to the Supreme Court, and the Supreme Court determined that yes, states can hold businesses that are selling online responsible for collecting and remitting sales taxes. So if you're an online retailer, you may have some obligation to other states for sales taxes because of the rules that are being put into place since this court case was determined. Now, each state gets to make up its own rules. Sometimes it's placing exemption amounts or requirement amounts based upon a certain amount of revenue generated. Other states are looking at the number of transactions that you have to that state. So maybe they're all small dollar amount, but you have a lot of transactions. So if you are selling to other states, you really need to get with your CPA and let them know what states you're selling to so that you guys can look up the rules in each of those states and determine whether you come close or not to the requirements. Now, this is just going to definitely be one of those generic statements, but as I go through the list, the common number that I'm seeing for the states looking at revenue is around $100,000. But like I said, it's a state by state thing. So that's something you may want to be looking at. And those are the three multi-state issues. Lou, did we get anything in on any of those topics?
Yes, we did, David. Speaking to that, so if I'm selling product online to other states, does that mean I may need to file income taxes in those states?
Yeah, so it could mean a couple of different things. So for, I'm going to start with the sales tax though. If the requirement to withhold and remit sales taxes is going to be based upon how many sales or how many transactions you have into that state. Then yes, if you're generating revenue from another state, if you go back to the three-prong test of apportioning your net income to other states, revenue generation is one of those. So again, you may have a little bit of revenue coming in from Idaho or Oregon or California, and depending on what their thresholds are for income tax reporting, you may have triggered the need to file income taxes in those states. And then of course, as I mentioned, just by having a remote employee in a different location, you could have triggered two things. You could have an income tax filing requirement and a payroll tax filing requirement. So all of these are becoming more and more prevalent. I have a potential new client that reached out to me asking if I'm able to do their return. And as we're talking through it, they are working remotely. And it sounds like both for an employer and as an independent contractor. And they jumped in an RV and they've been traveling the country for the last year. And as great as that sounds to the ordinary person, the issue that we're facing is that they are now earning income in all of those states that they are in while they're doing their work. So their employer has a nightmare if they're trying to track that for collecting and remitting employment taxes in all of those states. But even the employee themselves, or if they're an independent contractor, they need to be tracking how much they're earning when they're in each of those locations. And they're going to have a filing requirement in each of those states. How the states are going to catch on to that, I'm not sure. But when this comes to their attention, and it always does, they start working really hard and getting really creative of finding who those people are and being able to track them down and say, hey, you were earning a living while you were here for 2 months. And so some of that income is ours and you owe us tax. And probably the first state that's going to do that is California. So, how they're going to do it, I don't know, but these are the new headaches that we're being presented with the ability to have remote workers or being able to work while we're traveling. So the final topic that I had are just some other common issues. And because I want to be able to save some time for other questions that may have came in, I don't want to get too detailed on these. But these are items that when the IRS or the state comes in and audits you, these come up quite a bit. So I just want to make sure that if you're not familiar with the rules, that you spend a little time either reading about them or discussing them with your accountant. There are substantiation requirements, the support that you need to allow you to take a deduction on your return. And then just the general rules to being able to deduct it. So business automobiles, that's important to know. The actual costs and depreciation as opposed to taking a mileage deduction. Tracking your business use mileage, with a log, a handwritten log, or using a phone app, that gets overlooked a lot, but it's a requirement, and the IRS can disallow all of your deductions if you weren't keeping those records as they were occurring. So understand that the business auto rules. Another one is business meals. Marija touched on this at the very beginning. There's some changes there, but just knowing what qualifies as a meal and what doesn't. Because as a business owner, sometimes you just eat at work, or you think you can't go to lunch because you're too busy. That's not necessarily going to meet the requirement of being a deductible business meal on your tax return. So understanding what meals are allowed, what you need for substantiation, the detailed receipts, writing down who was there, what business was being interacted. That's all important stuff that you need to know. Same with business travel. I get that question quite a bit. What's an acceptable travel if you're a small business and you want to try to use a personal trip as a business expense? Very hard to do if you're following the rules. But you need to know those rules, and you need to make sure that you have the appropriate substantiation in place before you deduct it, so that if it ever gets audited, you're covered. The next one's also important. The independent contractor versus an employee. It's not uncommon that the government's desire is that we're treating everybody as employees. It makes the unemployment statistics look better. They get their different unemployment coverage premiums that they get to charge you, plus the different payroll taxes. And so if you are paying people as an independent contractor, you need to make sure that they meet the rules for that. And more often than not, you should make sure that you have a copy of their independent contractor certificate that was issued to them by the state of Montana. Make sure you have a copy of that in your files, which leads us right into the 1099 reporting. If you're paying an independent contractor for services more than $600 during the year, and they're unincorporated, then more than likely you should be issuing a 1099. If you get audited and you didn't do that, you can get penalized. And then just, general comments, home offices and employee benefit, different employee benefits. Just important that you know those rules if you're trying to take either one of those. They do get very detailed. But employee benefits, if you're looking for a magic bullet as a business owner, how to control or reduce your income taxes, that is one of those ways, specifically retirement plans and setting those up. So if you feel you have the profits to do so, be sure to talk to your CPA about retirement plans if you don't already have one, because they're generally the best way to kind of shift money from one pocket into another and reduce your income taxes at the same time. And that is the last slide I have. Hopefully we have time. Lou, I'll let you determine when we need to cut this off, but if there are questions, Maria and I are here to answer them. And of course, in our slides, we have our contact material. If you want to shoot us an email, at some later date for a clarification on something, please feel free to do so. But Lou, is there anything that we can answer before we take off?
Well, while we're waiting for some more questions to come in, we did want to say congratulations to JCCS for celebrating your 75th anniversary. That's awesome for you guys as a Montana business. So congratulations on that.
Thank you very much. Yeah, it's I think it's a pretty big deal for a business to make it 75 years. And, we have locations across the state in 6 different places, and always looking to grow and be part of the communities that we're in. So we're pretty excited, and thank you for bringing that up.
No problem. We really appreciate you guys being here. Wonderful presentation. So much good information. We're waiting to see if we have any other questions to come into the chat box. And while we do, there are a couple other things. One, we want to give a huge thank you to David and Maria for gifting their time today and sharing their expertise. We will have some announcements coming up very shortly. And while we do wait, our next blueprint is the Employee Handbook Essentials on February 22nd. So we look forward to seeing you then next month regarding that. Once again, thank you, David. But we want to thank you in advance for completing the survey when you leave today. For all of our wonderful participants, remember your feedback helps us improve the program and provide meaningful topics and content. And a reminder to copy the web link that was provided in the chat box to today's PowerPoint slides, or after you complete the survey, a link to today's PowerPoint slides will pop up after a few minutes when you click on leave at the end of the seminar. Okay. One of the other things, and Maria may want to take a look at this, is we would like to make sure to remind all of our employers today about our Employer of Choice Award. First off, do you love your employer? It's time to show some love and put some spotlight on what employers are doing great. If you love where you work, make sure you go to Job Service Kalispell's Facebook page and nominate your employer to be chosen for the 2022 Employer of Choice Award. The deadline is February 15th. Don't delay. Nominate your employer today. All right. So David and Maria, we want to thank you once again for your time. We don't have any more questions. So you guys must have answered everything for all 100 businesses that came in today to see what was going on. So you did a fantastic job. We really appreciate that. And if you're interested in reaching out to David or Maria and getting a recording of this or looking at their PowerPoint, you can reach out to them at these contact points and make sure you as a business get that valuable information to help you out for tax season. Thank you again, David and Maria. We appreciate you guys.
Thank you very much for having us, and thanks to all the participants for your time today.
All
Yes,
right.
thank you very much. It was a pleasure to be here.
All right. We look forward to talking to you again in the future. And for all of our participants, please stay on the line, fill out your survey, and look for the information that you can receive from David and Maria. Thank you once again for watching the Blueprint for Business Success seminar in January.